Welcome to part 2 of the evolution to self-dependence. This module is all about getting started on the right foot. We'll look at the best ways to set up your business, manage your finances, and plan for success in the first 5 years. The first step is choosing the best legal structure for your business. Whether it's a sole proprietorship, partnership, or a limited liability company, each has its benefits and tax implications. This choice will impact how you pay yourself, manage liabilities, and comply with local laws. Tip: seek local legal advice to ensure you are structured for both growth and protection. Choosing the right legal structure for your business can be crucial, but it doesn't have to be set in stone from day one. A two-step approach, for example, could be to start with a simple structure, such as a sole proprietorship or partnership, to minimize initial costs and compliance. Then, as your business grows and revenue increases, consider transitioning to a more complex entity, like a limited liability company, LLC, or corporation, to take advantage of more robust tax benefits and legal protections. Step 1. Start small with a basic legal structure that's easy to manage. Step 2. Plan for a more advanced structure when your business gains traction. Make sure to get good advice early on. Sit down with your accountant to understand both the immediate tax benefits and the implications as your business becomes more profitable. This will ensure you're not caught off guard by unexpected tax obligations later. Setting up your financial foundations is more than just choosing an accountant. It's about building a network of trusted suppliers who can support your business as it grows. Start with an accountant who understands small and medium-sized businesses and is also tech-savvy and digital currency friendly. But don't stop there. Look at your traditional banking options early on. As access to traditional banking becomes harder, securing the right support up front can make a big difference. We recommend using a different bank to your current personal bank provider. Don't have all your banking eggs in one basket. Key qualities for financial partners: experience with SMEs and digital currencies, strong compliance knowledge, supportive of startups and side hustles. Explore traditional banks, but also consider alternative options like fintech solutions and digital banking if traditional support is limited. Setting up reliable, flexible financial partnerships now will pave the way for smoother operations in the future. Setting up your financial foundations requires more than choosing the right accountant and financial partners. You'll also need to think about the technology that will support your business. Ask your accountant to recommend software that's specifically suited for your needs. If you're using digital currencies like COG, consider it like having an offshore bank account. This means you may need a multi-currency accounting license to manage various transaction types. Key considerations: multi-currency support for digital assets, integration with traditional and digital banking, real-time tracking of all financial flows. Remember, your software choice should not only support traditional currencies but also seamlessly integrate with digital currencies like COG. This setup will ensure you stay compliant while keeping your financial picture transparent and easy to manage as you grow. In the early years, it's common for your focus to be on maximizing tax benefits rather than immediate profits. Think of it as making every dollar you earn in your job more effective through strategic tax offsets. Your everyday expenses, like that morning coffee, phone bills, fuel, and even part of your home office, can become tax-deductible when they're tied to your side hustle or small business. Tip: work closely with your accountant to categorize these expenses correctly. Example: your daily coffee meeting with a potential client? Now it's a business expense. These deductions help reduce your taxable income, putting more money back into your pocket in the form of tax savings. So, while the first few years might not be about big profits, they're setting the groundwork for stronger financial growth in the future. One of the biggest benefits of setting up the right tax structure is having more cash on hand. But here's the catch: when we see extra cash, we're often tempted to upgrade our lifestyle, buy a nicer car, eat out more often, or take that spontaneous trip. This can quickly trap us in the working to survive spiral, where we need to keep earning just to maintain our new lifestyle. Key advice: don't let lifestyle inflation eat away at your gains. Instead, start the discipline early. Allocate 30% to 50% of that extra cash into your investment platform on Cogito. This strategy not only builds wealth but ensures your hard-earned money is being put to work for your future, rather than disappearing into short-term spending. As you start generating income, set a clear discipline. Consider donating to less fortunate or whoever is on your heart. We know the most successful people in the world give first. There is a spiritual reward to be had in this heart of thinking, so we encourage it. Then after this, invest 30% to 50% of your earnings. This habit will allow your money to start working for you, even while your business is still growing. Consider diversified investments that align with your risk tolerance and long-term goals. Tip: consistency is key. Automated savings and investment plans will keep you on track. Once you've established the habit of setting aside a percentage of your earnings, it's time to think about where to put that money to work. This isn't just about choosing one type of investment, it's about building a diversified portfolio. Start by doing your research on different categories: real estate, collectibles, precious metals, and more. Real estate: consider rental properties or even fractional ownership to generate passive income. Collectibles: these can include anything from vintage cars to rare art pieces, investments that combine passion and profit. Precious metals: gold and silver have been stores of value for centuries and can be a good hedge against inflation. Set specific goals for each category based on your risk tolerance and timeline. Diversification isn't just a safety net, it's a strategy to ensure that no matter what happens in one market, your investments remain balanced and continue to grow. Remember, if you are building a team to help you build this business, you want to lead by example. Create specific, measurable goals for both your side hustle and your investments. What does success look like for you in 3, 5, or 10 years? A well-defined vision will keep you motivated and help guide your decision-making as your business and investments grow. Goal examples: revenue milestones, investment portfolio size, asset diversification. Setting clear goals is critical for success, both for your hustle and your investments. For your Cogito hustle, there are 3 key areas to focus on: building your own sales team, expanding your client base, and continuously growing your personal knowledge. Building your sales team. Think of this as creating a mini organization within your business. Set monthly and yearly targets for recruiting and developing new members to expand your influence and capacity. Aim to grow your clients consistently. Set a goal for new client acquisition each quarter and work on maintaining strong relationships to keep them engaged. Commit to becoming an expert in the field. Set time aside weekly to learn new strategies, attend trainings, and keep up with industry trends. Knowledge is power, and it will differentiate you in the market. When it comes to your investments, start with a 5-year goal. In the beginning, consider a more aggressive approach, using the tax savings you've generated from your business setup and adding 50% of your Cogito earnings to your investment portfolio. This will allow you to leverage your early-stage tax benefits and set a strong foundation for future growth. Investment goals. Year 1 to 2, focus on building a cash reserve using tax savings. Year 3 to 5, gradually diversify into real estate, collectibles, and other categories, using a balanced approach. Remember, your hustle and your investments should work together. The more you grow your side hustle, the more capital you have to invest, and the more your investments grow, the stronger your financial base becomes. Think of the next 5 years as your foundational phase. The first 2 to 3 years are about learning and optimizing for tax benefits. By year 4 and 5, focus shifts to increasing profitability and scaling your investments. Stick to your investment discipline and watch your growth compound. Creating a 0 to 5-year plan is about breaking down your big vision into achievable, bite-sized goals. One effective way to stay on track is to put your goals somewhere you see every day, like beside your mirror. Each morning, you'll be reminded of what you're working towards. Year 1 to 2, laying the foundation. Focus on setting up your business, getting the right tax structure, and starting your first investments. Your goal here is to establish strong financial habits and create a small cash reserve. Year 3 to 4, building momentum. By now, your side hustle should be generating consistent income. Expand your client base and reinvest earnings into diversified investments. Create specific revenue and investment targets to keep you focused. Year 5, scaling up and refining. At this stage, you should be scaling up. Reevaluate your legal structure, set new goals for both income and investments, and look for ways to grow your influence and network. Every goal on your 5-year plan should be something you look at daily. Whether it's a sticky note on your mirror or a printed list on your desk, keep these reminders visible. It's a powerful way to reinforce your commitment and turn small steps into lasting progress. The journey to self-dependence isn't always easy, and you'll likely face rejection along the way. But remember, not everyone will share your vision or be motivated like you are. Sometimes a no or an "I'm not interested" isn't about your idea or your approach. It's a reflection of where that person is in their own life. Maybe they're dealing with challenges you're unaware of or simply not ready to make a change. Don't take it personally. Keep to your plan and focus on scoring your own goals. After all, it's your success and your journey that matter most. Measure yourself against your own milestones and remember why you started. Rejection is not a reflection of your value. Stay focused on your vision. The path to self-dependence is built one step at a time. Stay patient, stay committed, and always celebrate the progress you're making no matter how small it may seem.